There
Yeah,
we
there we
go.
go.
All
Yeah,
right.
All
Awesome.
right.
perfect.
Okay. Hey, Peter, how are you?
Not bad. How about you?
Okay, I'm doing good. I was really looking forward to talking to you today because the big debate now in the market is was that a low? A lot of people starting to believe that.
Mm-hmm.
So
Mm-hmm.
I'm wondering where your head is at on, and I know you
Yeah.
do a lot of sector stuff too. So I'm just going to let you talk and try not to interrupt you because your work is excellent. Go ahead, buddy.
Thank you, sir, and thanks for having me this morning.
Great to have you.
So, the short answer to whether the low was the low, I firmly believe it was. But
Okay.
from here, I see one of two potential paths that the S&P 500 and the market in general will take, and it all depends on whether the reopening of the economy will succeed against all odds, and whether we'll have in time or ahead of the potential second wave. Not that the first wave is over, but since they're forecasting a second wave in the fall, and America being America, will we surprise by having therapeutics in time for that, and potentially a vaccine like Pfizer assures us they will as soon as October.
Wow.
So I want to start with valuation for a minute using my valuation model. Jeremy Siegel on Friday had an interview, a very enlightening interview. And one of the takeaways is what he said about the value of stocks. He says more than 90% of the value of stocks is from earnings more than 12 months in the future. And I agreed with him because look at my valuation model here. I have 12 lines right here, starting January 31st, week over week. I've been plotting the forward S&P prices for Q2 2020 through Q4 2021. Now, late January, everything was nice and dandy. We weren't gonna be subjected to what China was experiencing. Actually, there was hardly any talk about the coronavirus. It's just a transient event.
Right.
But the S&P 500 was trading at Q1 2021 and Q2 2021 valuations, 3,315 to almost 3,400, meaning they were pricing in earnings 12 months forward, at least actually 12 to 15 months forward. Now, enter May 2021. We had that black swan event. We dropped all the way down to 2,200, a little less than that. And we basically erased the entire Trump rally, if that's what you want to call it.
Yeah.
We actually traded down to what earnings are telling us today, forward earnings for Q3 and Q4 2020, meaning we're still in Q2. So September 2020 and December 2020, fair value is down where we were in March and early April. Actually, March, because April, of course, we recovered. So we've already had the counter reaction to where we were in January and February. We had an equal and opposite reaction because based on 2019 earnings, which were about 140 a share, multiply that by a PE of 20, historical PE of average of 20, you get to 2,800. That's why over the last 2-3 weeks, we've been hovering or meandering around that 2,800 area, right? And in fact, the first leg down in March was down to where? 2,800.
Right.
So that was fair value. we dropped below fair value, and we had an equal and opposite reaction, meaning we traded 22% above fair value in February, and in March we dropped down to minus 22% relative to fair value. Okay.
Yeah. Yeah. Interesting.
Now here's the thing. Right
so
now, the
this rally was
S&P
like mean reversion.
exactly. Actually, we mean reverted to 2019 fair value, and then we did the opposite.
Yeah.
From greed to fear,
Right.
going through fair value. So now my original assumption was that we're going to mean revert to about 2,800. But then you have unprecedented liquidity on the part of the Fed. And stocks, as Jeremy Siegel said, always look or price in 12 months or more of earnings. So actually we're doing more than that, because right now we're in Q2 2020. As of May 1st, based on the forward earnings estimates, Q2 2021 would have been 2650. We're trading as of now, we're pricing in all of Q4 2021. In other words, the entire 2021 estimates, they're priced in. One caveat though, week over week, the forward estimates are improving. That's why you're seeing the blue line crossing over the red line. And I don't have
constructive when it's
constructive.
above the red.
Yes, because what's happening is last week or 2 weeks ago, the forward estimates for Q2, Q3, Q4 2021 were the red line. Now they're improving. So the forward price estimate for the S&P as of for Q4 2021 is 3,000. So they're pricing in everything already, and that's the troublesome thing. But however, if week over week that blue line or the next line for next week will be above the blue line, then they're going to keep chasing that, because as Jeremy Siegel said, we're looking ahead 12 months or more. But here's the trouble. Here's the ES, the S&P continuous contracts. We had an ABC decline, the S&P decline in ABC fashion, traced out an inverse head and shoulders bottom that has a measured objective of about 3,100. That 3,100 is in the span of the B wave, towards the top of the B wave, okay? So there's something else also. If you look at the same chart, I have the DeMark indicator here. We had a bearish price flip after that B wave ended. And I think that's when we had our interview, right about that time. We had a bearish price flip, and technically
I think it was a day after. Is this a daily chart?
This is a daily chart.
Yeah, because you said, I think there was that gap told you to get out of the way the next day.
Okay, exactly.
That's what you said.
Right.
See, I mean, I remember everything people say at every interview.
I appreciate you reminding me of that, because I forgot what I said. But
okay.
That bearish price.
What's your name again?
Yeah.
All right, just kidding.
I know what I'm driving though. And who the previous owner of the car is.
All right.
So that bearish price flip is when the closing price exceeds to the downside the closing price 4 days earlier. So we closed below the closing price of that green bar, and we went on to make a minimum of 9 consecutive closes each below the closing price 4 bars earlier. So the trend was definitely down. And suddenly we had a bullish price flip, a green bar that basically reversed the work that the last 4 red bars did. Okay.
Yeah.
And from there on, we rallied, had a bullish price flip again here, and we went on to make 9 consecutive closes above the close 4 bars earlier. Right. So we had that. So again, it seems
2,400 was big.
Right. So we're progressing towards that resistance zone, which TDST, by the way, is another indicator. It's the top of the bar that printed that bearish price flip. So that That's 30.37. The top of the B wave is about 31.30, 31.37, according to this. Yeah, that's this red bar, the high. That's when we reacted to the first intervention, the Fed intervention, that they did the first rate cut. I don't know how much it was, I don't recall. And then everybody sold into it, and we did. And then, of course, the next leg was much bigger than the first one. So TDST 30.37 and then 31.37, that is the danger zone. And by the way, we are down today. I'll explain why in a minute. Here's the trouble with this, okay, from a valuation perspective. If we get to 30.37, 31.37, we'll be trading at a PE relative to trading 4-quarter earnings, which as of today, they're about 125, 126. So if you multiply 125 to 120, they're exactly, as of May 1st, they were 125.55. So my model tells you that, or suggests that every time the PE reaches 24 or higher, we are in the danger zone. We're liable to have a precipitous decline. Whether this will happen this time around, in light of the fact that we are in a liquidity-driven situation, and also we have earnings and the market, and not earnings, I'm talking about presidential elections coming up, and we have a market that's hopeful that we've dodged the bullet. So there's a lot of hope riding on this. But again, if we reach that zone, we're already trading at above 23% PE. If we reach 24 to 25, this is where the biggest moves down began from. So that is the danger that I'm seeing.
Okay.
Now, forecast. Here's my forecast that the low for blue wave 4 is in place, okay? Whether we retest it, whether we move sideways for several months, I personally believe, firmly so, I'm a firm believer that the fourth wave of the super cycle, and look how much work I've done here. I haven't shown this chart before.
Yeah, you go back to when I was born.
Yeah, almost.
1871.
Right. So I go back to when there was actual data, and some of that data wasn't even S&P 500, because pre-1957 you have the S&P 30, the predecessor, and then you have data from an economist by the name of Alfred Coles. So
I knew him.
You knew him, huh? You went to school with
we had
him.
a couple of beers together.
Anyways, here's my super cycle. You're funny, then. It's a good way to start the week with a little bit of humor.
All right. Well, it's tonic. So that's it then, Peter. I mean, 4, and maybe I see you have some squiggly lines off the 4.
Yeah, because I don't know what's going to happen here.
Yeah,
you can have another wave, and the market can take two different. That's why I'm talking about two different possibilities. So you have wave 1, and then you had the .com bubble burst, failed double top, and a retest that was a sideways move. I call this, of course, and explain it to that. That's wave 2, around the 50%, and then you have wave 3, a little less than 50%, which is good, because when wave 2 exceeds 50%, you're expecting wave 4 to not reach 50%. It's the principle of alternation. So we got just below the fourth wave, the yellow fourth wave, and then we bounced back big time. Now, how fast we're going to get to 5 depends on, again, what's happening with the reopening of the economy, the prospects of having a vaccine, therapeutics, whatever, that would ward off a second wave of that coronavirus. So in the long term, we're all dead. That's my long-term forecast. That's what I'm seeing happen in the next, say, 3 to 5 years. Now, here's the Dow Jones. We talked about this in the last interview, is that I'm expecting it to either stop at the yellow line or meaning the top of the pitchfork, or continue on down to the 18,000 area to test or back test the blue line. And that's exactly what we got.
Wow.
Okay.
Yeah.
It was
Nice.
incredible when I saw that. And
Okay.
here's the forecast, same exact forecast, slightly different than the S&P. The S&P had a sideways expanded flat. The Dow actually printed its fifth wave in time or right ahead of the financial crisis, came down, tested the fourth wave, that was wave 2. And then wave 2 was about 50%, and so was wave 4. In other words, everything we built up or everything we gained in 10 years, half of it was lost in a matter of 2 weeks.
Yeah.
So now, again, my forecast calls for the fifth wave to end somewhere around 36,000, maybe more, depends on what happens. Because, towards the top, you have blow-off tops. You have hysteric moves, basically, to the euphoria. So, again, we'll see what happens. Anyways, the important thing is the SOX. We talked about this a lot because the SOX, semiconductors drive everything. And the reason why I'm excited about the SOX, because you don't let a crisis go to waste. Technology will always offer solutions to problems. One day we might walk into a building and there'll be sensors testing us, measuring temperatures, whatever. You walk through some sensor and it tells you everything about what's going on.
Amazon has those in their warehouses now.
So imagine how much progress, technological progress, because you can never underestimate science and technology. So that's why I'm so excited about what the SOX is doing, because you have this massive cup and handle. And after we broke out of it, that breakout was really fifth wave. So coming down to retest the breakout zone was the least you would expect. And that's exactly what we got. That's why we bounced back so vigorously. So I'm looking for the SOX.
So it's 5 of big 3 in all of these when you have the 5 up there. We ended the third wave, we got a fourth wave pullback, and now we're into 5 of 5.
We're into something. I don't know what that is, because the SOX didn't begin at 0. It began 30, 40 years ago. I don't know exactly when, the 80s, maybe. I'm not sure exact. I forgot when the SOX was constituted. So the only visibility I got is this. I know that it's going higher. Okay. Whether this was wave 1, this was wave 2 at the 2009 bottom, and this is wave 3. I don't know. I really don't know. So only the future will reveal what's going on with the wave structure for the SOX. All I know right now is that this big, massive cup and handle has a measured movement of about 2,600. Okay.
Okay. So plenty of room.
That's 57% higher from here.
Okay. Yeah. I know this is one of your favorite groups too, that you love semis.
57%, if you go back to the S&P, where the target I have up there is 48%. So the SOX will outperform the other indices. Keep that in mind.
Okay.
So short and intermediate, that's what I'm interested in looking at. What path can we possibly take? So let's say that everything works out and the economy reopens and we have vaccines and therapeutics in time to ward off, because remember, without a vaccine, forget it. I mean, they're opening bars and things like that. I heard in South Korea and other places, and they're seeing spikes in the virus. So only a vaccine and effective therapeutics can deal with what's going on. So assuming that we do get the ultimate, the ideal outcome, then what's going on here is a series of wave ones, wave twos, and it's hard to believe that we're in wave three right now because of that decline we just saw here, but it's possible. So if we break to new highs, let's say that the late April highs are somehow exceeded by the ES, then we could be back at the highs, and that would be wave three, the burgundy one or pink.
Yeah.
And then wave four would be a handle. Then wave five would see us at 36 or 3,700 on the S&P. And you know, you've heard some people talk about the 3,600 target on CNBC recently, more than once actually.
That's where the megaphone upper line comes in.
Yeah, but here's the thing. Those same guys calling for these targets, they were calling also for 3,800 and 3,700 and 4,000, whatever, before we got that bear market. So
that's why I turned the volume down.
Yeah, and the same guys who were calling for those lofty valuation or those lofty targets. When we got down to 2,200, they were calling for 1,700. So exactly, you got to turn the volume down and see what you're seeing.
Learn to depend on no one but yourself.
Right. Now, let's say that we fail. We don't have therapeutics in time. We see a second wave, which would be devastating to the economy. Then this rally, as we approach presidential elections, will probably be target of the inverse head and shoulders, which is about 3,100. Let's say that we end up that whole rally end up being a double zigzag, a counter trend rally. You know, right now it looks like a V, right? It looks like a V, but it could easily turn out to be something like this. Okay, so the second phase of the bear market is an attempt at retesting the lows, but it might end up being a triangle, a wait and see kind of triangle. Because remember, you have unprecedented liquidity being pumped into the market. So they will provide a backstop for stocks. So you could see a triangle here that would last several months, and this whole thing ends up being a W, not a V. Okay, and a lot of smart people are talking about a W, while the reactionary people are talking about the V. Okay, now, is it the first time that we see a correction ending up in a triangle and ending up at a higher low? No. In fact, if you go back to last year, the market rallied into May 2019, had the first pullback into early June, had a failed breakout, and then ended up tracing out a barrier triangle, an ascending triangle that ended in October. So this whole correction from early May, actually printed new highs, but all in the context of a consolidation that ended in early October. And then we broke out. And if you recall, last time I said a triangle precedes the last move in the direction of the prevailing trend. And then we saw what we saw in February and March. So again,
nice.
Okay, this is the other possibility. And before that is, of course, the pipe dream. This one is the pipe dream right now. Okay, so that's why I'm trading on a very short-term basis. Everything I'm doing is short-term. I'm not betting on what's going to happen in 3 years. If you buy Apple now, you're going to be rewarded 2-3 years from now. I don't care for all that. So here's the Nasdaq, by the way. The Nasdaq overnight made a new high, but it ran into the 2020 value area high. If you see it here, the red bar, the red candle hit the value area high and pulled back almost to the VPOC. So, you know, things can change. Things can turn on a dime. One day you have a rally with incredible breadth. The next day, it's like, you know, it's bipolar. It's a bipolar market. So right here, even though the Nasdaq is near the highs, and the TDST is really the high. And this looks like it's developing into a V also. We could easily reach 88.6%, maybe not even make a new high before pulling back. In fact, those who think that we're already out of the woods because we're near the highs, I'd like to remind them of 2015, 2016. Summer 2015 decline was then, or set the stage for a rally to a new intraday high. And then guess what? We came back and tested the A, the wave A. That was a running flat. A running flat. B is higher than the starting point of A, and C fell just short of A. Typical running flat. So anything can happen. I can never say to anyone we're out of the woods.
You know, it kind of makes sense, Peter, after that dramatic move, dramatic recovery, that we have 5 months of uncertainty into the election and the fall of sideways movement,
Right.
a battle between the bulls and the bears, because they
Right.
both have arguments until, like you said, there's a vaccine.
Exactly. That's the most important thing. Here's the other thing. I'm not so sure anymore. You know, last time we talked, there was the prospect of a socialist administration
Bernie
coming in. Remember all that? That's out of the question now. So right now, I don't really think the market cares who gets elected. The market cares about what the Fed is doing, right?
All right. Yeah.
And so I don't think the market is going to react one way or the other to the outcome of the presidential election. That's
a great point. Yeah, that Bernie's out of the picture.
Exactly.
Yeah. And
now the Russell, if you look at the Russell actually had a great April. The month of April was great for the Russell. It was able to recapture North Territory, the 2-4 line. We got back above that line and above the yellow line, and actually May got off to a good start as well. So we'll see whether this mean reversion can reach 1450. That's where I would expect it to bump into resistance. Okay. So the Russell is recovering, and it should do so if the reopening of the economy works out. You know, all these small businesses and whatever. You know, right now we're sort of in a deflationary environment, despite all that. And we're going to talk about gold in a second, but the economy is closed or semi-closed. If I go out to a car dealership, who do you think is going to get the upper hand? I'm going to walk out with probably whatever price I want. They're dying to sell a car, right? Now, if the economy reopens, all that M1 money, all that liquidity, it's going to have to find a home. So the economy, for however long, I don't know, the wheels of the economy will start turning again. And I don't know what will happen to unemployment. I don't think we'll see 3.5% unemployment anytime soon. Okay, I bet that the S&P, if and when it makes new highs, the unemployment won't be anywhere near 3.5%.
Yeah.
So this is the Russell. It's making headways. We'll see how far it'll go. The banking index. Now, the banks are depressed, whether you look at the Nasdaq Bank Index or the BKX. And the reason is
yields.
Net margin, right? So you have banks that are basically net interest margin. So if you look at net interest margin, you have banks that are loaning money at what? They can't make money in a zero rate environment, but they also have holders of savings accounts and certificate of deposits. They have to pay interest on that. So if their net interest margin is not as favorable as it is when interest rates are higher than zero, then you can't expect banks to do well. So all those guys buying banks and whatever right now, I'm not even looking at banks. So here's what concerns me. You have banks not doing so well. You have the Russell, lagging the S&P 500. And then you have also the transports pretty much near, I mean, they've recovered some, but the recovery is nowhere near commensurate to that of the S&P or the Nasdaq. So those types of divergences are very worrisome to me. And remember, those are the types of divergences that precipitated this decline. Because if you look at the transports, we have a classic Dow theory non-confirmation in 2020. The indices were making new highs, yet everybody was ignoring the fact that the transports were still below their 2018 highs. Okay, so that was, you know, that was one of the reasons that I was predicting this decline. So transports now, if the economy reopens, you know, and people start flying again, because the only way people are going to really fly again if there's a vaccine or effective therapeutics. I'm not flying anywhere if you put a gun to my head unless there is a therapeutic or a vaccine. So again, so transport, it's not unusual for the transports to lag behind the other sectors. You know, every rally, every turning point, 2014, 2015, 16, the transports were lagging, but they eventually broke out to new highs, except in 2020. So this could be a case of let's wait for those vaccines, let's wait for the therapeutics, and then if they become available, then the transportation sector should benefit.
Okay.
The other worrisome sign is the breadth of the S&P, the breadth of the S&P as I measure it in terms of the equal weighted relative to the cap weighted. This thing has been on a decline forever because what's propping up the cap weighted are the big names, the mega caps. That's why the S&P 500 equal weighted, which was actually outperforming the cap equal weighted was outperforming the cap weighted up until 2016, 2017. And then from there on, it embarked on a journey down to almost the 2019 lows. So breadth has been on the decline due to the most of the money pouring into the mega caps. They're outperforming everything else. But in recent days, we've seen a consolidation, a range bound, which could end up being the starting point for maybe a reversal, however short-lived that would be in terms of months or whatever. So it's not encouraging at all for me long-term.
Okay, so you presented a lot of bullish stuff at the beginning, and now you're showing the flip side of the coin.
Right, that's the
what do you give the weight? What do you give the weighting to and the bias for?
So remember, the bullish is long term.
Okay.
The intermediate and the short term, I said we could take one of two paths. It could go one way or the other in the short term, depending on therapeutics and whatever. So here's the thing. Junk bonds, they've actually, you know, they had a cataclysmic decline, and then the Fed came with their $2.3 trillion program. They're right now trading above the late 2018 low. At one time, they had a problem staying above the early 2016 lows, but it seems that they're experiencing a turning point right now. I am long HYG actually.
Oh, interesting. Looking for what? A retrace move?
Well, I'm looking for, I'm long. When I say long term, I'm talking to May or June.
Okay.
Staying above a certain value. Okay. Now, here, what's encouraging is the spread, yield spread, IEF over HYG or IEF or over junk. So 7 and 10 year treasury bonds relative to corporate bonds. When the Fed came with their $2.3 trillion program, we saw this huge gap down that reached the 50-day moving average. Then we had a technical bounce, and as of Friday, this ratio dropped below the 50-day, and which is good for stocks because now what this is telling you is that HYG, the price of corporate bonds, is rising faster than the price of treasury bonds, meaning if I'm
I've
a
noticed that.
company, if I'm a company, I can sell bonds at a high price and not have to pay an exorbitant yield for that. So I can borrow. Borrowing credit seems to be favoring stocks as of last Friday. So we'll see if this.
So you think the Fed is sacrificing sovereign performance to get performance out of junk?
I don't know. What do you think?
Well, I don't know. I think that we've taken on a lot more debt that's going to have to be printed. So the sovereigns are, like you just said, are underperforming. Also, one other point, Peter.
Yeah.
The administration talking about canceling the payment of bonds owned by China. I know it's bellicose, it probably wouldn't happen. But, you know, if we keep going tit for tat for China, it wouldn't take much. They wouldn't have to unload their whole treasury portfolio. All they'd have to do is sell a little to cause some type of panic in the bond market.
Right. Yeah. I don't
think
know.
about
Well,
that at
you know,
all?
here's what I'm thinking. I'm thinking that if uh, we're gonna pay the piper at some point for all the debt that we're accumulating, it'll probably be the top of the fifth wave from the super cycle fifth wave. Let's go back to this for a second. Where was that?
Okay.
Right here.
Yeah.
The fifth wave. Now, the beauty of all these corrections is that we can always estimate the downside of a fourth wave relative to the size of the third wave, so on and so forth. But if a super cycle reaches a fifth wave, the downside could be anything. I could retrace 61.8%, 50%, 78.6%, 88.6%. The crash, the potential for that crash from the top of the fifth wave, you can never estimate that anymore because you have a completed 5-wave move, and the counter or the ensuing bear market could retrace up to 100% of that.
Okay. Best guess for how much time the Fed bought us for this move to fifth wave high at your targets.
Exactly.
2023 ballpark, 24, 25.
You know what?
Sense in time.
Somebody taught me, somebody told me recently or asked me, what's the time frame? I said, well, if I were you, I'd start building a bunker now, you know, because I don't know time-wise when that will happen, okay? I would say 5 years, in the next 3 to 5 years.
That will get to the high of wave 5.
Yeah.
Okay.
In this decade.
Okay. All right. That's a fair bet. Okay.
Last thing I want to talk about is gold. I was a little whipsawed by gold recently. And the reason being is I believe that the trade is very crowded. Everybody comes on and says 1,800 and this and that.
Yeah.
And so the thing is, right now it feels that my dollar has a lot of buying power because, you know, there's nothing going on out there. People are dying to do business. So I can go out and buy a car anytime I want for whatever price I want.
Cash is king.
Right.
Yeah.
So, and we talked about this pattern last time.
Did you get your $1,200 from the government?
No.
Me
I
either.
haven't seen nothing yet.
Yeah, I know. They don't pay traders, I guess.
You don't think so?
They were supposed to. All right, so let's see. All right, so we got the smiley face here.
So we had the pattern in gold that looks bullish. And, you know, I was betting on it staying above 160 through May 15th expiration. I don't know where it's at right now. I haven't looked. And then I got out of that position because I felt that the trade was way too crowded and maybe my time frame is not long enough. So I was looking at it yesterday, and I see what's been happening over the last 2-3 weeks. A triangular consolidation. If you look at this on
isn't this a wave 4 that would imply one more thrust to the upside?
Yeah, and I think that would take us maybe to in the 170s, almost 180. Okay. But it would be a wave 4 of not the highest degree. It'll be 1 degree less. In other words, there'll be another wave 4 to follow it of higher degree to form a handle for that cup. So we have a triangle consolidation happening at and around the value area high for 2020. So I don't know whether it got down below 160 today or not, 159 or so. But I feel that once it breaks above last week's high, this should constitute a legitimate breakout, taking us to the highs. And by the way, it's corresponding.
Okay, well, that's what people are talking about, 1800 on
Right.
the breakout.
So it's coinciding, by the way, with the reopening of the economy, meaning if the market starts to function again, or the economy starts to function again, there's economic activity, then, we could start seeing inflation at some point. 3 to 4%, as Jeremy Siegel was talking about. He's not expecting hyperinflation.
What would be your bear case? Do you have a bear case for gold?
For gold?
Yeah.
Yeah. And by the way, at one time, since we talked, I changed my mind 3 or 4 times on it.
Yeah, it's okay.
And the bear case for gold is that gold has always been a hyperinflation hedge. Okay? Hyperinflation hedge. Because think about it, in 2000, when did they do the QE3? Was it 2013? QE3? I don't recall exactly. But if you recall, when they did QE3, the gold made a lower high. And then despite that QE3, it went on to lose almost half of its value from 1900 or 1800 down to 1000 or 1100. So it was an incredible, bear market in the last 7 years. And despite all the zero interest rates, and we never saw inflation. In fact, there were.
You have a bearish technical argument for it?
Yeah, the bearish tactical argument is a double zigzag that has yet to complete. And
which would mean what?
So let me see. Let me see if I want to bring up my.
And then I want you to give people information on how they could follow you and keep in touch with you.
Absolutely. So if you see here, we had an ABC, XABC. At one time, last month, I felt that this C wave right here is really the 5th wave of A. And I can make a case for that, which means that this right here is B and C is coming.
That's what I think.
Okay. And
all right.
So that's why I'm out of the gold trade.
Yeah.
Until it breaks above last week's high, then I'm willing to take a shot.
Okay.
But if it drops below this triangle,
if the breakout
ends up being to the downside, then I'll start, if this breaks down, then this value area high is going to fail and we're going to head back down. Okay. And here's the thing. I felt that every single rally in gold in recent weeks was, forced. It felt forced, like a technical move, because people see, the gold doesn't want to rally. It seems that it's doing it despite itself. And that's what is worrisome about it. Unless a lot of money flow, there's been a lot of flow into gold, and the trade was so crowded and everybody was front running it ahead of what they're expecting to see happen. And the consensus is 180. And guess what happens to consensus?
Yeah, either never gets there or blows through it. Yeah,
exactly. And in a nutshell, that's all I got. I hope it was.
Well, you had plenty, man.
I appreciate
it.
that.
And really a great presentation. You're getting comments. Rick said, very good guess. Nice work in charts. Clear, shows both sides, cause and effect without pushing bias of market direction.
Absolutely. Very much appreciated.
FX trader, great. Elliotician. Okay. So anyway, great work from Scott Henderson. Thank you for edifying the F.A.C.E community today, my trading warrior brother.
Thank you so much for having me. I look forward to talking to you again.
Okay. So is your Twitter handle the best place for people to follow you, Peter?
Yeah. Peter Ghostine, at Peter Ghostine. I should
Okay,
have had
buddy.
a slide here with my information, but it's first name, last name. It's that
Okay.
simple.
All
And
right. Well,
much
thank you,
appreciated.
buddy.
And
Yeah,
anything I
we'll
can do
set up
for
a
you, let me know.
date later today for sometime in the summer and keep this narrative going. Okay, buddy.
Sounds great. Good luck and thank
So
you.
everyone, my trading warrior brother Peter Ghostine, can follow him at Peter Ghostine on Twitter. That's a wrap, and see everyone for Turnaround Tuesday. Here at Peter Ghostine, you're welcome, Tian, and I'll see everyone tomorrow. Don't just count your pips, count your blessings. Adios.